see everybody today. It's way easier to watch a drawdown from the sidelines from a podcast fairly frequently called Value Hive. Largely is a lot of nerds and hedge fund managers, but it's just such a great line that I had to share it. And it was the header of the market letter that we sent out to everybody last on Monday when things have just been so ugly. But we are so much out of the market that it's way easier to watch this with being from the sidelines and mostly in cash because there's not a lot to invest in right now. So that's where we're sitting. All right, long-term trend. I'm not going to go too in-depth into this. There are other videos that you can go. I go into more depth into what it is, but it's been negative for quite some time. Little peaks back in, what was it, December, January, and then nope. And then March, it tried to come back and then nope. So long-term trend is not pretty right now. So there's that. Midterm trend cycle. Again, March had that trying to do okay. After it was choppy in February. It was just messy because things were trying to improve after the drop in January, but the whole Russia-Ukraine thing really kind of made things uncertain and very volatile, much more so than it had been really ever. But we've kind of come back to a natural cycle. You know, things are good. And then this really wasn't much of a good time from point to point. It was a good rebound, but then we're just back in this drawdown situation. That's where we're at. But because we're down here, we're playing it largely safe and the long term backs it up. So we've just very cautious and largely out of the market. The sector strength, 1 to 10, 1 being energy is the only positive sector. But on the MACD, it's been negative for 2 days. It's not positive. We've looked at it many times as something to own, try to offset, but it's so volatile. It can be up 2-3% or down that much in the next day. So it's really hard to own something like that in this environment, even though I think there's a lot of good potential for it. Really interestingly is the ADX trend on all the sectors except for discretionary is negative. That means if ADX trend is positive, is moving up and we're on the red side, this is the negative side, that means these are trending down. At least that's what the interpretation of the data is. And all the MACDs are negative. So there's just nothing, no sector is safe. Energy, like I said, is kind of safe relatively, but big picture, it's just not. So beyond that, I wanted to go, I've been traveling quite a bit and I want to share some highlights of the Cmt Symposium. I've actually been to 3 conferences in the past 2 weeks and just a lot of great information, but CMT specifically has just some great topics on markets and, chart nerds like myself, and we'll have to talk about those things. So I'm going to go through some highlights. Jim Bianco at Bianco Research is just fascinating to listen to. I actually quoted this in a newsletter, I think a month ago. But he said, we are at the 1-year anniversary of transitory. How's that working out? Right? Can you believe 1 year ago, Janet Yellen said, this was Janet Yellen. I think it was Janet Yellen said, this whole inflation problem is transitory. It's not going to happen. It's nothing. Don't worry about it. And here we are now with inflation we haven't seen in 40 years. So they definitely don't have a handle on what's going on. Other interesting thing, Fed related, is that another former New York Fed said if stocks don't fall, the Fed needs to force them. That should be a concern and kind of a red flag to everything else going on as well. It seems like the Fed needs to push the market down to help with inflation and interest rates, and then they don't have to be as aggressive on the upside. But his expectation was that the next 3 Fed meetings, and this was 2 weeks ago, so we did get this 50 basis point rate hike. The expectation is the next is 75 and the one after that is 50. Now, in the last Fed minutes, they said, no, we're not going to do 75, but I think it's probably likely. And then beyond that, 13 rate hikes are not priced into the S&P. What normally happens is the belief, on Wall Street now is that the government kind of comes in and bails out before it gets too bad. So there's, it's not been priced in the full effect of the Federal Reserve raising interest rates as much as they probably need to, because it's believed that before that happens, government's going to step in and stop things. But I don't know. I don't have a good feel for that, but it's really interesting. But that means that the market has a long way down. A long way to go on the downside if that is true. There was a panel. Ralph Acampora was like a legend, like one of the first technical analysts on Wall Street. I mean, back when believing technicals was some sort of black magic. But they said based on the charts, markets could continue another 15% down. This was 2 weeks ago, and I think we've already gotten half of that. Another thing, crypto they were talking about is not backed by anything, and crypto is ugly right now. And it could get much, much worse. And about a year ago, we put a downside target on where we thought Bitcoin could go. And it's getting close to where it's breaking those levels and we could see those things happen. But crypto is not backed by anything. But big names are interested in it. But there are no fundamentals. You can't say it has this valuation, it has this worth. It's only technicals that you can trade on it. So that's an interesting situation to be in because it's really hard to value what these things are worth. I mean, and there's a lot of speculation and argument about it. But, end of the day, I don't know. I don't know if these things are worth something or not. I'd like to think so. I mean, if some of us own these things, but very cautious, very concerned what's going on out there. Helene Meisler, oh, amazing. Okay, this lady draws her charts by hand every single day and has been doing that for about 30 years. And she thought February 2021 was the top of the market. And we were saying something similar back around that time too. We saw like the bottom was falling out, like most stocks were going down back then, but the S&P was still going up. So the problem was the retail investor, the average person was going, oh no, the market's fine, it's going up. We're watching like 80% of the market fall. And that's tough. And that's when the majority of stocks started to go down. So we've seen this for a while. And she expected the Nasdaq to break prior lows. This was 2 weeks ago. It has. So she was definitely right on that. And then finally, I believe there was a panel with John Rogue and George Noble. If you follow George Noble on Twitter is fantastic. He's a little edgy on this and on his beliefs, but he's fun to read. So when Brent crude goes up 100%, which it has, recession follows. I mean, that's another thing in addition to the yield curve inversion that we got a month ago, 2 months ago now. We're heading into it. We may be into it now. I mean, we've talked to Will Hepburn, who's on vacation this week, but we've discussed that it's very possible we're already there because we won't know it and it won't be announced until quarters after it's happened. It's like, oh yeah, we were in a recession back then. It's possible we're there now. I don't know, but for sure, but it's feeling like it. There are definitely some issues. The Fed doesn't have a clue what the average person is experiencing. And what they were talking about here is that going back to the Fed needs to drop the market to not have to be so aggressive on the interest rates rising, is they believe that most people, the average American, doesn't have money in the stock market. It won't be affected, not as much. They're kind of like, oh, we're hurting the rich people, so it's fine. We can hurt the stock market. And that's might not be as true as they think. And these guys believe that that's why the Fed does not have a clue what the average person is experiencing. And this could also create unemployment much faster. There was something interesting this morning on it was Yahoo Finance saying that they were wanting corporations to stop hiring to help with that. It's just some strange things going on. And then finally, Nasdaq is in trouble because Apple is 50% overvalued. That, the Apple is a large percentage of the S&P 500 and the Nasdaq. If that does drop 50%, that's not good for the major indexes. Now, there are other things that might hold it up because they've already done their falling, but that does not bode well for where this could go. I don't know if this was their opinion, not mine. I just thought it was really interesting to think about because I love seeing what other people are thinking and talking about. And then finally, equities offer return-free risk right now, right? So owning equities is owning risk without the benefit of it. And I just thought that was one of the best quotes I've seen in a while to describe this market. It's really difficult out there. But to go back to the don't worry or the don't panic, be happy, we're largely out of this market. There's no reason to be invested. We've got so much pulled out. What we do have in is very small, and it's usually to offset something else that's going on. We do own a couple things that have actually done well this year to offset the risk. So we're not too concerned about what we still own. We may hedge it in the future with NASDAQ. Last month, I did a whole market neutral presentation that's really interesting if you want to go back and see. That's something we're going to kind of do off and on as needed. It's still in a testing phase, but that's where we're at. But yeah, be happy. If you're with us, you're not experiencing it. And that's the best we can do. So that's today. Stay safe out there.